If you're worried about a potential 2026 recession and you're not sure how to position your investment portfolio in Europe, this video is for you. I'm Marcus, I'm 29, I'm a software engineer in Stockholm, and I have about 52,000 euros invested across ETFs, retirement accounts, and cash. Right now, everyone's talking about market volatility, high valuations, and whether we're heading for a downturn. In this video, I'm going to walk you through exactly what the actual risks are, what the data says about European markets specifically, how I'm positioning my 52,000 euro portfolio, and the 3 things I'm doing right now that you can copy whether you have 500 euros or 50,000 euros invested. Let's jump right in. So, first things first, let's talk about what's actually happening with markets right now, because there's a lot of noise out there and it's easy to get caught up in the fear. The S&P 500 just had a pretty good January, up about 1.5%. But early February has been choppy. We're seeing some volatility pick up. And here's the thing. The US market is trading at about 26 times earnings right now, which is high by historical standards. Not crazy bubble territory, but definitely not cheap. And whenever you see valuations at these levels, people start asking, is this sustainable? Are we due for a correction? But here's what matters for us as European investors. And this is super important. European markets are in a very different position. The Euro Stoxx 600 actually outperformed the S&P 500 inches 2025 up over 17%. And European stocks are trading near fair value right now, not overvalued like the US. According to Morningstar's analysis, European equities aren't cheap, but they're not expensive either. They're basically fairly valued. Now, what about recession risk? JP Morgan puts the probability of a US and global recession in 2026 at about 35%. That means there's a 65% chance we don't get a recession. The European Union is forecasting GDP growth of 1.4% for 2026. That's not amazing. It's modest, but it's growth, not contraction. Inflation in Europe is close to central bank targets. The ECB has already done a pretty good job bringing rates down, and recession fears have actually been reduced compared to where we were last year. So when I look at all of this, here's my honest take. I don't think we're heading for some massive financial crisis in 2026. But I do think we're in for a bumpier ride than the last couple of years. Markets went up pretty steadily in 2025. That's probably not happening again. We're going to see more volatility, more ups and downs, and that can be really uncomfortable if you're not prepared for it. The big risk isn't necessarily a crash. It's that valuations have gotten to the point where there's less margin of safety. If you bought European stocks back in April 2025 during the tariff scare, you got them at almost a 20% discount. That's a huge cushion. Today, you don't have that cushion. So if something goes wrong, geopolitical shock, unexpected inflation spike, whatever, markets could drop pretty quickly and you'd be in the red fast. But here's the thing, and this is really important. Being worried about volatility and actually changing your long-term investment strategy are 2 different things. If you're a long-term investor, which I am, volatility is not your enemy. It's actually your friend, because it gives you opportunities to buy when things are on sale. So let me tell you exactly how I'm positioning my portfolio right now, with about 52,000 euros invested. And by the way, this breaks down to about 34,400 euros in my investment portfolio, which is mostly UCITS ETFs that I'm investing in through Avanza, about 10,000 euros in my emergency fund, 5,700 euros in my Chensta pension, and about 1,800 euros in crypto, which honestly, I'm not even counting on because it's so volatile. The first thing I'm doing is making sure my emergency fund is solid. I have 6 months of expenses covered, which for me in Stockholm is about 10,000 euros. This might sound boring, but it's the most important thing you can do before a volatile period. If markets drop 20% and you need money, you do not want to be forced to sell your investments at the bottom. Having cash means you can ride out any downturn without panic selling. And honestly, it also means if you see a really good buying opportunity, you have dry powder to deploy. If you're just starting out and you don't have an emergency fund yet, that is priority number 1. Even if markets look attractive, build that cash cushion first. 3 to 6 months of expenses is the goal. For me, I'm actually thinking about pushing mine to 7 or 8 months just to have extra buffer this year, because I'd rather have too much cash than not enough if things get rough. The second thing I'm doing is staying fully invested, but being very intentional about what I'm invested in. I'm not trying to time the market. That's a losing game. I'm not selling everything and going to cash hoping to buy back and lower. That almost never works. But I am making sure my portfolio is diversified and focused on broad market exposure, not trying to chase hot sectors or individual stocks. My core holding is a UCITS version of a global market index, basically MSCI World. This gives me exposure to thousands of companies across developed markets. I also have about 20% in emerging markets through another UCITS ETF, and about 10% in European small caps. And the reason I'm comfortable holding this through volatility is because I'm not investing money I need in the next 5 years. This is long-term money. If it drops 15% next month, I'll feel it, but I won't sell. I'll probably buy more. And that's actually the key mindset shift. In volatile markets, you need to see drops as sales, not disasters. When Stockholm has a 25% off sale at H&M, people line up. When the stock market drops 15%, people panic. It makes no sense. You're buying the same assets, the same companies, the same earnings power, just at a cheaper price. Now, small cap stocks in Europe are particularly interesting right now because they're trading at about a 30% discount to their fair value, according to Morningstar. That's a pretty significant opportunity. Small caps are more volatile, they'll get hit harder if we do see a downturn, but for a long-term investor, that volatility can work in your favor. I'm keeping my 10% allocation there, and if we do see a market pullback, I'd probably increase that to 15%. The third thing I'm doing is dollar cost averaging religiously every single month. Right now, I'm investing about 1,300 to 1,400 euros per month into my portfolio. That's roughly 35 to 40% of my after-tax income. And I'm not trying to time when I put that money in. First of the month, money goes in, automatic, no matter what the market did yesterday or what headlines are screaming at me. This is so powerful during volatile periods because you're buying at different price points throughout the year. Markets go down, great, you're buying more shares for the same amount of money. Markets go up, fine, you're still building your position. Over time, this smooths out your average purchase price and removes the emotional decision-making that destroys returns. If you're earning less than me, or you're just starting out, the same principle applies. Even 50 euros a month makes a difference. Even 100 euros a month, the amount doesn't matter as much as the consistency. Because the person who invests 100 euros every month for 10 years will do better than the person who tries to invest 1,000 euros only when they think the market is cheap. I want to talk about what I'm explicitly not doing, because this is just as important. I'm not moving money into gold or crypto hoping they'll protect me in a downturn. Gold can be part of a portfolio, but it's not something I'm rushing into. Crypto is too volatile for me to consider it in a safe haven. I learned that lesson watching Bitcoin drop 70% in past cycles. I'm not trying to pick defensive sectors like utilities or consumer staples thinking they'll hold up better. Maybe they will, maybe they won't. But trying to rotate between sectors based on market conditions is basically market timing, and I'm not good enough at that to make it work. Neither is almost anyone else. And I'm not listening to anyone who claims they know exactly what's going to happen. No one knows. The people predicting a crash have been predicting a crash for 3 years straight. Eventually, they'll be right, and they'll say, "I told you so," conveniently forgetting all the gains you would have missed if you'd listened to them. So here's my honest position. Do I think markets could drop 10 or 15% this year? Absolutely. Do I think we could see more volatility than we saw in 2025? For sure. Do I think that changes what I should be doing as a long-term investor? Not really. The European market outlook is actually pretty reasonable. We're not overvalued. Growth is modest but positive. Inflation is under control. Interest rates are coming down. Yes, there are risks. There are always risks, but there's no flashing red alarm saying, "Get out now." What I'm focused on is controlling what I can control. I can't control whether markets go up or down this year, but I can control having an emergency fund so I never have to sell in a panic. I can control staying disciplined with my monthly investments. I can control not trying to be clever and time the market. And I can control keeping my costs low by using cheap UCITS ETFs instead of expensive active funds. At the end of the day, if you're investing for the long term, and I mean 5, 10, 20 years, the best strategy in uncertain times is usually the most boring one. Keep buying, stay diversified, don't panic, and remember that every single time markets have dropped in history, they've eventually recovered and gone on to make new highs. I'm 29 right now. Even if we do get a recession in 2026 and markets drop 20 or 30%, I've got decades to ride that out. And honestly, if that happens early in my investing journey, that's almost ideal because I'll be buying at lower prices for years while things recover. If you're in your 50s or 60s and close to retirement, your strategy should be different. You need more in bonds, more in cash, less in stocks. But if you're younger, volatility is your friend, not your enemy. So that's how I'm positioning my 52,000 euro portfolio for whatever 2026 brings. Emergency fund locked in, staying fully invested in diversified UCITS ETFs, dollar cost averaging every month, and not trying to be clever. It's not exciting, but it works. If you found this helpful and you want to see more content about building wealth in Europe using actual European investment strategies, hit the subscribe button. Next week, I'm breaking down exactly which UCITS ETFs I'm using and why I chose them over other options. That's it for me. See you in the next one.